What are some important considerations involving a power of attorney? There's a lot of confusion out there about what a power of attorney can and cannot do and when it operates. So on the program today, we're going to talk about that, along with why you shouldn't be a bandwagon investor. To our friends on the sports network 96.9 The Game, hey, it's okay to be a bandwagon fan if you are with the Tampa Bay Buccaneers, right? But perhaps you don't want to follow the same approach when it comes to your investing. We're going to give you some reasons to be thinking about that as well. Welcome to the program. Of course, this is Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. My name is Joel Garris. I'm a certified financial planner, certified financial fiduciary with Nelson Financial Planning, where our team of certified financial fiduciaries stands ready this week to help you change your life with a successful and cost-effective financial plan that produces superior investment results and provides you with peace of mind for the future. So before we get into the power of attorney and bandwagon investor conversation, we wanted to talk specifically about a couple of headlines out of Washington this past week. There's always a lot of headlines out of Washington each and every week, but every now and then there's more topical conversation about your money. The first, of course, is the headline that more people were talking about. Certainly fielded a couple of calls in the office this past week, and that has to deal with the increase in the capital gains rate. More specifically, when is that going to come into play? So Biden, of course, announced his $6 trillion budget. He's working with a little bit more money than you and I work with in terms of funding the government, but he announced a $6 trillion budget that assumes that his proposed capital gain rate, and again, talking about increasing the capital gains rate up to being ordinary income tax rates, his proposed increase in the capital gains rate, according to his budget, there's the assumption that it actually happened already in late April. So when you look at his budget and kind of where the money comes from and where the expenses are going, there's an assumption in there that caught a lot of investors sort of by surprise, and that was this assumption that it was going to be retroactive to the date that he detailed the plan originally, which was April 28th, making it effectively too late for investors to be able to make decisions and to try and engage in transactions that would capture lower capital gains rate. And understand the rationale behind it. I mean, first of all, Americans aren't stupid, and so when you see something like that happen, it does change your behavior. You can look no further than to some of the prior changes to the capital gains rate. Back in 1986, there was a 60% jump in capital gain realizations, and then in 2012, again when the capital gain rate also changed, there was a 40% jump in capital gain realization. So it's not like there isn't some data out there that says, hey, you know, we don't necessarily want to give people a long lead time into these changes, because then they're going to react and they're going to engage in behavior that basically ensures that they get the lower rate. So there is definitely some history to kind of engage in some kind of retroactive activity. But here's the thing about retroactive congressional activity, particularly when it comes to taxes. First of all, and most importantly, Congress has to approve it. So before we get to worrying about the implications, the reality is that Congress still has to approve it. And retroactive policy, that's really hard. And we think that that's unlikely, particularly with a split Senate, that you're going to have a hard time kind of getting some type of retroactive tax policy through. Here's the reality, though. I guess the bottom line in all of this, these tax changes are pretty high likelihood that they are in fact coming. And so as an investor, if you are thinking, or you're in a position where maybe you're selling a business or maybe you're selling a piece of property that you've owned for a long time, and there is a significant capital gain in there, I think it goes without saying to say, well, you know what, I'm going to try and get that done this month. I'm going to try and get that done in the month of June. And yeah, granted, these tax changes may very well be retroactive to the end of April, but at the very least, if you at least attempt to try and accelerate the transaction, then you may get a shot at having the lower rate. So certainly something for investors to be aware of on that. May already be very well be too late. At least that's the assumption in the budget. But as we all know, assumptions in budgets have a tendency to be very different in reality when in fact they become law. So certainly that's pretty important distinction, but certainly one that would give you pause to say, okay, well, certainly I need to kind of maybe accelerate this, and particularly if you've got a transaction that's got a large capital gain, it would make sense to try and do some acceleration on that. Excuse me. Well, we've talked about this before, sort of the other headline out of Washington this past week, and that has to deal with the Federal Reserve. The background, of course, for this story is obviously the reaction of the Fed and the Federal Reserve and the Federal Reserve Chairman to the crisis that obviously occurred with the pandemic and the shutdown of all the various parts of the economy. What we've said before in the program, and this I think really needs to be underscored, the reaction of the Fed to this crisis really was an order of magnitude greater than what we saw the Federal Reserve do back in the 2008 financial crisis. And you look no further than some of the platforms or some of the vehicles that the Fed was afforded to be able to do that were much broader and much deeper than the ability that it had back in the peak of the financial crisis. A good example of that is the platform that sort of made a little bit of headlines this past week. That was known as the Secondary Market Corporate Credit Facility. And what it did was, it was obviously passed at the peak of the financial crisis, at the peak of the pandemic crisis, about a year ago. And it allowed really an unprecedented, never happened before. It gave the Federal Reserve the opportunity or the ability to go into the corporate bond market, not the Treasury market, which is where it still very much is functioning now with the quantitative easing and all that. It allowed the Federal Reserve to go into the corporate bond market and purchase bonds and bonds ETFs as of April the 30th. In fact, it had about 14 billion of said bonds. About 5.2 billion were in companies that we know, like Whirlpool, Walmart, and Visa. The other portion of it, a little over 8.6 billion, was in the form of ownership of ETFs that held corporate debt. Well, this past week, it was announced that that would all be being wrapped up by the end of the year. And the notion behind why it was established was because it really was thought to be necessary in order to keep the markets flowing nicely, in order to keep the markets flowing smoothly, particularly in the bond market. Interestingly, though, when you kind of look at the numbers, and certainly, $14 billion sounds like a lot of holdings, the reality is that the effect of that was really more psychological than anything. So the Secondary Market Corporate Credit Facility, and actually there was another vehicle, a related vehicle called the Primary Market Corporate Credit Facility, which interestingly, they never bought anything under that corporate facility. The holdings of the current position peaked at about 14.2 billion, far short of the approximately $750 billion that the Federal Reserve had the capacity to purchase. What are the implications? Clearly it was overkill, right? Unnecessary to go to that extent. Number two, it's another example of a Fed flip-flop, because last June, Federal Reserve Chairman testified to Congress, hey, you know what? We are buy and hold investors when it comes to these bonds. We're not going to sell any of them. We're just going to hold them to maturity. Well, guess what? They announced last week that they are in fact going to be selling those and all selling them off by the end of the year. So some interesting headlines out of Washington this past week with some interesting implications in terms of timing and retroactive tax changes. And certainly this notion of the Federal Reserve starting to unwind. This is step one of the Federal Reserve unwinding the easy money that was pushed out during the pandemic. With that, we're going to take a break and continue the conversation here on Dollars and Cents. Up next, powers of attorney and what you need to know about them. A lot of folks have a lot of questions about what are some of the essential elements behind a power of attorney. And there's one interesting thing about a power of attorney that we always run into, which is perhaps one of the biggest misconceptions about a power of attorney. So this segment of the program, we wanted to spend some time talking about what a power of attorney is, first and foremost, some of the things you need to sort of consider if you're about ready to make a power of attorney, along with some of the different characteristics or traits that you may see in a power of attorney depending upon which type of one that you have created. So welcome back to Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a variety of networks, welcoming in our audience over on the Space Coast. Just started broadcasting on 92.7 WMMB over there as well. Of course, we're on News Radio WFLA Orlando, along with 96.9 The Game here in Central Florida. So we're sort of fully covered here geologically, and the reality is we're also, I guess, covered globally when it comes to our podcast and our YouTube channel. So if you're interested in catching our podcast, be sure to subscribe or find us on your favorite podcast service of choice. Just look us up under Nelson Financial Planning. That, of course, means that I am Joel Garris of Nelson Financial Planning. I'm a certified financial planner, certified financial fiduciary at Nelson Financial Planning, where our team of certified financial fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So, first of all, what is a power of attorney, and where do you typically kind of see it into play? Well, power of attorney is basically a legal document, right? I mean, it's not something that you would typically see written on, an index card. It's a legal document. It requires a notarization. And so what it does is, at the end of the day, when you sign a power of attorney, you are giving someone else the ability to act just like you in whatever the circumstances that you have outlined in the power of attorney. And we'll get to some of those circumstances. So you can have a broad one, a limited one, a specific one, or a general one. We're going to get to all of those distinctions here in a little bit, but just conceptually understand that a power of attorney really is a document that allows someone to act as you under the circumstances prescribed in the power of attorney. So when would that be good to have? When would that would be effective? Well, the reality is, like, if you were all of a sudden became incapacitated and somebody needed to make financial decisions. Generally, a power of attorney is thought of as more of a financial or business related type of document. There are other things like a health care surrogate that sort of operates the same way, but it's related to health related decisions. So when you think power of attorney, think business stuff, think day-to-day life stuff, writing checks, balancing the checking account, purchasing a home, purchasing real estate, purchasing an investment, any of that stuff. That would be where a power of attorney would come into play. Now, obviously, if this legal document gives somebody else the ability to act just like you, there's some important considerations to consider on that, right? First and foremost, okay, trust but verify, right? The reality is that if you're going to appoint somebody, make sure it is somebody that you really do know and trust very well, because they're going to be able to operate just like you, and that is going to be legally binding. If they sign a contract or something like that, that is a legally binding document if they've signed it pursuant to a power of attorney. So make sure that whoever you name, you really do know that person well, and ultimately you trust that person. Once you've signed the document, tell others that you've signed it. One of the troubling things that can sometimes happen is that all of a sudden someone shows up at the office and waving a power of attorney. Oh, I've got a power of attorney. And we've got a specific procedure in place where the power of attorney has to be within a certain period of time. It can't be some power of attorney from 20 odd years ago, because the reality is that a power of attorney can easily be undone by signing another power of attorney. So it's important that you tell people that you've signed a power of attorney, and also tell people when you sign another one. It's one of those things that you've got to make sure that folks are fully updated on it, because the reality is that if you change it and someone walks around with the old one, then you may have somebody operating as you, and you don't really want that person operating as you anymore. So that certainly is something to make sure that you share that with folks. The reality is too, go with someone you know, go with someone that you trust, because all too often in today's world, there's a lot of people wandering around out there that burst on the scenes and say, oh, I'm here to help, and the reality is they might not be. So if you're going to sign a power of attorney, trust but verify. Make sure it's someone that you know, that's been around a long time, and make sure folks that would typically be the ones that would have to deal with the power of attorney, like your financial advisor, your business partner, those types of things, those would have to be the folks that would need to know about the power of attorney. So good to inform them of that along the way. So certainly some important consideration as you're making that power of attorney. Next up, here's and I want to really highlight this. There's one thing about power of attorneys that is perhaps the one thing that sort of nobody knows, or everybody sort of gets confused about. And the reality is that a power of attorney stops, is invalid, does not exist, is immaterial once someone passes away. All too often people say, oh, well, I've got a power of attorney, but they passed last week. And the answer is the power of attorney is done. The power of attorney has no more validity once someone passes. It is intended to be a document that allows someone to act as you, but you got to be alive in order to have someone act as you. So the reality is, and people all the time get confused on this, power of attorney, throw it out, shred it, burn it. If that person dies that gave the power of attorney, then your job is done. There's nothing more to be done on that. So what are some of the specifics about a power of attorney? Well, it can be a general one, or it can be a specific one. Obviously general, much broader. You may not want to have someone have the ability to do everything. Open up investment accounts, change beneficiaries on policies, enter into contracts, enter into leases, borrow money. All of that. You may not want them to have that general power, which means that you may want a specific one. Another distinction is, do you want that to be a durable one, or do you want that to be a springing one? Durable means that when you sign the document, that's it. That power of attorney, that power has been granted, and ultimately that person can start acting you right now. From the second you sign that person can act as you. So maybe you don't want a durable one. Maybe you want a springing one, which means that they have to prove that you're incapacitated, and that's the way that the document that they will be able to act in your place. Now, again, pros and cons on that, right? Because if it's a springing one, then you got to go through the process of proving incapacity. That can take some time if folks need to operate. So just understand that the difference between general versus specific, the difference between durable versus springing, all of those are important distinctions to note when you are crafting a power of attorney, because you can have a lot of different versions of a power of attorney that may or may not be applicable to the particular situation that you're looking for. So just know those different aspects of the power of attorney and how that all plays out. Power of attorney, important document to have, because it helps with managing financial affairs if you are not of correct capacity to be able to do that. but just understand that there's some pitfalls along the way as well. With that, we'll take a break and return here on Dollars and Cents with Joel Garris of Nelson Financial Planning. So you've all heard the expression of hopping on a bandwagon, right? A lot of folks hopped on the Tampa Bay Buccaneers bandwagon this past year, and obviously that was a good bandwagon to hop on because they won the Super Bowl. But there are other bandwagons that maybe you should hold off on, particularly a lot of the investing bandwagons that are out there. We've certainly talked a lot about some of the new things that are out there that are getting a lot of people's attention over the course of many of the programs over the course of the past year or so. Today on this program, we wanted to give you certain reasons or explanations or thoughts behind why you may really want to hold off on hopping on that bandwagon. But there is one bandwagon that we do want you to hop on, and that, of course, is the bandwagon that is Dollars and Cents. So we're Central Florida's longest running radio program. My name is Joel Garris. I'm with Nelson Financial Planning. I also happen to be a certified financial planner, certified financial fiduciary. Our team at the Office of Certified Financial Fiduciary stands ready this week to help you change your life with a successful and cost-effective financial plan. So there's a lot of bandwagons out there, and particularly in the sports world, that's typically where you find that. But I think there's also can be a lot of bandwagon jumping on finances and investing as well, right? Your friends and neighbors can certainly make it seem like everybody is getting rich these days, whether it's cryptocurrency or non-fungible tokens or sports cards or gold coins or whatever the case may be. There's always a lot of conversation. And so what happens, just basic human nature, is the old FOMO sets in, right? The fear of missing out. You feel like, well, if everybody's doing it, well, then I should do it. If everybody says, keyword says, that they're making so much money so quickly, I want to be part of that too. So that emotion is a very powerful emotion that can really lead you to making decisions that are not particularly great. And here are some of those limitations if you go with the FOMO or bandwagon approach to investing. Number one, you're not going to be able to predict the future. I know, maybe you think you can. Maybe you think you've read the tea leaves sufficiently enough to be able to figure out when to get in and when to get out, right? I mean, that's the real crux of anything when it comes to something that is having a huge run up to the point where it's on everybody's mind, it's on everybody's lips, it's in the mainstream media. The reality is that you won't know when to get in or get out. Think about GameStop and sort of what that transaction looked like, of being able to know what's going on and be able to be in front of it, right? I mean, in early 2021, excuse me, no one in the financial press was talking about GameStop, right? It was trading at $18 a share. It was only when the stock had skyrocketed, gone up to 400% in a single week, that everybody else talked about it. Well, the problem with that is that once everybody's talking about it, chances are everything has already happened with it. And so you're coming late to the party, and that underscores the problem with the jumping on the bandwagon, is that by the time you know about it, it's too late. You didn't know about GameStop at the beginning of the year. You didn't have any idea what was trading. It was a old retail store that was selling games, most of which you can download now, or at least I think that's what's happening when my kids are playing that stuff. The reality is that nobody really was paying attention, and then all of a sudden it goes up 400%, and everybody's paying attention. The problem is that those got in at that point wound up having the other impact happen, which of course is that stock really did pull down pretty dramatically from those highs that it saw in January. Here's the other part of it from a tax perspective, right? And there's a lot of folks that are running into this, particularly with crypto, because this past tax year, 2020, was the first year where the IRS said, hey, we want to know about your crypto trading, and particularly we want tax revenue off of that. Well, here's the reality. Most of that stuff is going to be short-term gain in nature. Short-term gain in nature is taxable as ordinary income. So be careful about that, because that means that that's taxed just at your highest possible marginal tax bracket. You don't get any benefit for it being a long-term capital gain and subject to lower capital gains rates. The reality is it's short-term capital gain that is taxed just as ordinary income. Much like the timing, getting in, getting out, investment trends change. Nothing lasts forever, particularly when it is in the financial press. When it's garnering that much support, when it's garnering that much reaction, the reality is that nothing lasts forever. And the trend on it is certainly going to change. Here's another thing to consider when you're thinking about jumping on a bandwagon, and this is something that we've certainly talked about a lot in previous episodes. What you're doing is not investing. What you're doing is gambling. And understand that, if you want to try that and, do that, that's fine, but don't confuse that with investing. Investing is about time in, not timing. Understandably, that's not as exciting. And at the end of the day, though, it is far more likely that with investing, time in the markets rather than trying to time whatever it is that you're buying, in fact, that consistent behavior will allow you to achieve your financial goals at a much regular pace than just trying to figure out, hey, I'm going to try and predict the future. Another big distinction, it's really time consuming, right? Because you got to stay on top of it, because this bandwagon stuff really does have a tendency to move very, very quickly, right? So if it's moving very, very quickly, you've got to really be paying attention. Otherwise, you're going to be on the wrong side of it. The other thing that comes with that people have shared with me over the years is that it's super stressful, right? I mean, if you're seeing something run up dramatically, it becomes stressful, because then the pressure is to make the right decision. So as with anything, when it comes to timing something or hopping on a bandwagon, there's really two decisions that you get right. You got to know when to get on and when to get off. And those are two very hard decisions, that the degree of which you're going to get those to get accurate, those two decisions accurate, right in a row, it's impossible. And so it becomes a time-consuming and very stressful activity, missing out. So say, you saw GameStop running all the way up, you thought it was going to keep going to the moon because that was what they were saying, and now it came back down. Well, now you're stressed because you lost all of that money. You had a huge opportunity that ultimately disappeared and slipped right through your fingers. The reality is that that's an unsustainable strategy. You might get lucky once, you might get lucky twice, but as an investment strategy, it's just not sustainable. The other thing too, as we said, taxes on a short-term basis, the transaction also can be pretty expensive as well. You may say, oh, well, if I'm buying and selling stuff, I go to like one of these apps or on an online trading platform that don't cost me anything. Well, how'd those work out when you actually wanted to sell it? There were a lot of restrictions and a lot of shutdowns on some of these low-cost, zero-cost types of providers. Look, bottom line on all of this, slow and steady wins the race. The reality is that the long-term average of the S&P 500 is at about 10% per year. There has actually never been a 20-year rolling period of time in history where the S&P 500 has lost money. It's about consistency. It's about time in, not timing. It's about avoiding the hot bandwagon, as attractive as it may sound, the stress associated with that, the amount of time that you're going to consume, the series of decisions, not just one, but the series of decisions that you have to get right in order for that to ultimately work out, really does leave you with a tough or a bad taste in your mouth, because the reality is it's just not sustainable what you're doing. At its very core, you are not investing, you are gambling. So be an investor, not a gambler. Stay off those bandwagons. With that, we'll take a break. When we come back, we're going to talk about some of the things that make every person's retirement plan unique. There are 3 things that we're going to talk about, and we really want to underscore each of these because it makes for a very unique plan for each and every person out there. Coming up next here on Dollars and Cents with your host, Joel Garris of Nelson Financial Planning. You know, we talk about every person's financial situation is different and is unique. And whether you're planning for retirement or educating your kids or any of those kinds of things, each individual is unique in its own regard. And I think far too often that there are just a lot of cookie cutter approaches out there these days. And certainly on this program, you've heard us rail about all of these target date investment funds that are out there. They're becoming pretty much the only option in most employer retirement plans. And then along with just sort of the slew of online calculators out there that certainly are good general rules of thumb. I mean, don't get me wrong on that. But the reality is that there are 3 distinct factors that go into really creating a unique solution, a unique retirement plan for each and everybody. And we wanted to kind of go through those factors and make sure that you were aware of just how big they can have in terms of impact on what your financial picture looks like. So welcome back to the program Dollars and Cents, where we help you make sense out of all of life's decisions involving your dollars. We're Central Florida's longest running radio program, coming to you on a variety of networks throughout Central Florida. So we welcome all of our listeners on radio, along with our listeners at their convenience on our podcast channels. So make sure you subscribe to us on our podcast channels. If you go to your favorite one and look up Nelson Financial Planning or Dollars and Cents with Joel Garris, you will certainly find us. If you have trouble with that, feel free to go to our website, nelsonfinancialplanning.com, and then there, upper right-hand corner, you'll see a bunch of icons. Click on the one that looks most familiar to you, and you'll get directly connected to our channel on your media platform of choice. We also do a YouTube video. Right now I'm being filmed, and so ultimately we'll put the show up as a YouTube video as well. So check out our YouTube channel at Nelson Financial Planning. My name is Joel Garris, certified financial planner, certified financial fiduciary with Nelson Financial Planning. So what are some of the 3 key things that you've really got to kind of put in your mind in terms of these are going to be some unique aspects to how my personal financial picture or my personal retirement plan looks like? And chief among those is time horizon. I think just thinking of your time horizon, 5 years makes a big difference. Consider these numbers, and this looks at the difference between retiring at 65 versus retiring at 70. If we assume a 7% return, and let's say you started saving at the age of 40 and you plan on retiring at the age of 70, so a nice 30-year time period, and you save $10,000 a year, and again assuming a 7% return, over the course of the 30 years, under those parameters, your accounts will grow to just over $1 million. If, however, your time period is not 30 years, but it is 25 years, and you say, oh, well, I'm going to start at 40, but I'm not going to go to 70. I'm going to only go to 65. Here's the difference in the numbers. Again, same parameters, saving $10,000 a year, assuming a 7% return, you wind up with $677,000. Now, $677,000 is a lot of money, but that's not $1 million. So what your time horizon is, your time frame between when you start saving and when you ultimately retire, it can have a big difference in the return, right? Just those 5 years, there's a 50% increase, 667,000 to over $1 million. That's a 50% increase in the amount of money that you have to work with in retirement. And obviously that's why you hear often it's important to start early, because those last few years make a big difference. That's the power of compounding, particularly as those balances start to grow towards the end. So not just that time horizon before, during retirement. I think people say, oh, I'm going to have a 25-year retirement, 30-year retirement, and that's fine, and you just absolutely plan for that. But understand that the time horizon, or that time period from when you start saving until you get to retirement, that also is going to be pretty important. Number two, again, this one goes without saying, but it's expenses in retirement, right? So if you're spending money in retirement, that can make a big difference in terms of how much money you need, right? You may say, oh, well, I'm going to save $1 million, but if you're having to spend $80,000 a year in retirement off of that $1 million, the $1 million is not going to be enough. Meanwhile, if you say, well, I've got other sources of income, Social Security, pension, whatever the case may be, I only need $20,000 of income in retirement. The reality is that a $500,000 portfolio is going to work very nicely for that. That's about a 4% withdrawal rate versus the situation where, oh, I've got $1 million, but I need to spend $80,000 a year off of that. That's an 8% withdrawal rate. That's a much higher withdrawal rate, much greater risk of running out of money. So understand that expenses matter, and how much you're going to need makes a big difference relative to the value account. $500,000, half the amount of money, but a retirement that is much nicer, particularly if you only need $20,000 off of the account versus, say, $80,000 off the account. And then lastly, rate of return, right? Rate of return makes a huge difference in terms of how your numbers play out. Allocation does matter. Consider the example we were talking about earlier. The reality is, if you take the 7% assumption in terms of rate of return and you shift that up to 9%, the person that has that 30-year time horizon starts at 40, goes to 70, saving $10,000 a year, assuming 9%, it winds up being $1.5 million that you have versus $1 million. So just even 1 or 2% can make a big difference. In fact, next week on the program, we're going to give you some even more specific data on how big just a little bit of a difference in the rate of return can make to your portfolio, and the amount of time that you're going to have to enjoy that portfolio in retirement. So understand those three things, which make every person's financial picture, retirement picture, unique. Time horizon, expenses, how much you're going to need, and your rate of return. With that, we will wrap it on up and get on out of here. Thank you all for listening to the program. This has been Dollars and Cents. I'm your host, Joel Garris. I'm with Nelson Financial Planning, and thank you for listening to this week's program here on News Radio WFLA Orlando, 96.9 The Game, and WMME 92.7.